Hey, welcome everybody and good afternoon. I'm Donald Marin, Director of Economic Policy Initiatives here at the Urban Institute. Thank you for joining us for today's conversation about taxes and entrepreneurship. We're thrilled to have a lot of people here in the audience at Urban. Thank you for braving Friday the 13th to come out. We also have lots of folks watching online. Thank you as well for joining us. We encourage all of you to share your thoughts on social media using the hashtag #LiveAtUrban. And for online viewers, please ask questions and share comments by emailing events@urban.org. As you all know, entrepreneurs play a vital role in our economy. They develop new products, think of new ways to manufacture goods and services, create new and better jobs. Entrepreneurship is essential to our prosperity. It's essential to rising living standards. So it's important that we understand how government policies affect it. Right? How do government policies affect entrepreneurial ventures, the people who choose to found them, the people who go work for them, and the investors who potentially provide funding to them? Policies can affect entrepreneurship in many ways, right? Through securities law, through immigration, through employment policies, through intellectual property. But today we're going to focus on tax policy and how it can affect the rewards to being an entrepreneur, the willingness of investors to provide capital to new and growing enterprises, and how it might affect people's willingness to work for them. Exploring that link between tax policy and entrepreneurship is particularly important at the moment given the high profile that tax reform has. As many of you have heard, a new president will be taking the oath of office exactly a week from now. Both Mr. Trump and the new Congress have tax reform near the top of their agendas. And many of those policymakers have very big, bold thoughts for how they might reform the way that we tax corporations, businesses, workers, and investors. So it's important that we understand how any of those changes may affect the entrepreneurial dynamism that drives our economy. I look forward to a wide-ranging discussion of that today with the other panelists. Two additional notes. First, let me thank the Ewing Marion Kaufman Foundation for supporting the Tax Policy Center's work on tax policy and entrepreneurship, and this event today in particular. And second, let me note that we had originally hoped to have Ann Canfield Roth of Fenway Summer Ventures join us today to provide us perspective from the venture industry. Unfortunately, a work conflict intervened and she wasn't able to join us, and so I'll be joining the panel instead. Now let me invite all our panelists to come up on the stage, and let me turn things over to Jean Sahadi, senior writer at CNN Money, who will moderate today's discussion.
Two waters.
In case you forget who we are. Oh, the mic is live now. Can you hear me? No? Yes? Can you hear me? Okay, good. Again, to reiterate what Donald said, if you're inspired to tweet, it's #LiveAtUrban, and if you have any questions, if you're watching online, feel free to email them at events@urban.org. I'm going to just introduce the panelists briefly. They're going to each give their take, a very particular take on the issue of entrepreneurship and taxation, and then we'll have a discussion before turning it over to everybody here. Eric Toder is the one who set this panel up. He's an Institute Fellow at the Urban Institute and co-director of the Tax Policy Center, where we are now. His areas of expertise, I think, are too numerous to mention in taxation, but I always call him on corporate and business tax because it's by far the most difficult for people who are not tax experts, so thank God he exists here. He previously held a number of positions in the US government, including Deputy Assistant Secretary for Tax Analysis at Treasury, Director of Research at the IRS, and Deputy Assistant Director for Tax Analysis at the CBO. Susie Morse, who's next to him, comes from the University of Texas School of Law in Austin, where she's a professor. Her areas of expertise include international tax reform and tax compliance, as well as taxation at startup firms. In addition, she's the tax section editor for what, to me, is one of the best named legal blogs you've ever heard of. It's called jotwell.com, which stands for Journal of Things We Like Lots. It highlights the best and most interesting in new legal scholarship. Earlier in her career, she clerked for the Honorable Michael Boudin of the United States Court of Appeals for the First Circuit and spent 7 years in business tax practice at Ropes & Gray in Boston and at a really long-named firm in Palo Alto, California. I don't want to mispronounce anyone's name. Bill Gentry is next to her. He's a professor of economics at Williams College. He specializes in, among other things, the economic effects of taxation, corporate finance, and public finance. He's also the co-editor of the National Tax Journal. Bill has written or co-authored a number of papers on entrepreneurship and taxation, including a recent one on capital gains, which he's going to talk a bit about today, household savings, and entree into the wonderful world of being an entrepreneur. He served as a consultant to the Treasury, and he was on the staff of President George W. Bush's advisory panel on federal tax reform in 2005, which probably many people here know about, but for anyone who doesn't, their report still lives online. It's wonderful. It was a great panel. I highly recommend people in Congress look at it too, whoever's involved in tax reform today. Lastly and firstly, we have Donald Marin, Institute Fellow and Director of Economic Policy Initiatives at Urban. In these roles, he focuses his attention, again, on, these people do so much, right? So tax reform, long-run fiscal challenges, federal budgeting, public finance. Prior to that, he ran the Tax Policy Center for 3 years. And before joining Urban, he held several senior government positions, or as he puts it, I've been blessed to serve at the best acronyms in government, the CBO, the President's Council of Economic Advisors, and the Congressional JEC, Joint Economic Committee. He also writes a great blog, which I recommend, which is where, as he puts it, he muses on economics, finance, and life, and sometimes puts up beautiful photos of wildlife, right, as a bonus. So, okay, so we're going to hear first from Eric about a paper that he just wrote, which probably is available certainly online, if not outside, about how he chose to measure the effective tax rate of entrepreneurs, how he defines them, and how they might fare under the various proposals that we've been seeing from House Republicans and Mr. Trump, President-elect Trump. Yes, go ahead.
Okay, thank you, Jean. This is probably a little bit different for me. I'm probably as far from an entrepreneur as anybody can be. I've spent my life in the public sector and in the think tank world and academics, and so we are analysts, and entrepreneurs are the opposite of analysts. They're doers and risk takers. So the first question, I guess, when we ask about taxing entrepreneurs is, what is an entrepreneur? And there are all kinds of definitions involved there. From the Merriam-Webster, a person who starts a business and is willing to assume risk in order to make money. From Joseph Schumpeter, who is a classic economist who wrote about this, an innovator who brings together existing productive resources in new ways for new purposes. He highlighted creative destruction, which was essential for economic growth. Another author in the Harvard Business Review described somebody who pursues opportunity beyond resources controlled. Note that these last two are really very expansive definitions of somebody who's going out and doing something new and risky. The person who's starting a business maybe is assuming some risk, but is not necessarily, according to this definition, an entrepreneur. We don't think, or many of us don't think of a small mom and pop store operator as an entrepreneur. We think of somebody who's actually trying to create something big and something new. So this is important because the innovation entrepreneurs produce are key in mature economies to driving long-run economic growth. We don't get all that much economic growth from having more people or more capital per person. The real driver is being able to do things better, and that's what the entrepreneurs are creating. Also, recent data by the BEA shows, when you look at investments, the share of investments that are accounted for intangible assets has risen over the last 30 years from about 10% to 30%. So we're becoming an economy that's much more intangibles and know-how as opposed to bricks and mortar as what's important for creating values. So I would describe, sort of in an operational technical term, entrepreneurs are creating firms, and the value of the firms they create are worth more than the physical assets that are in the firm. So they're creating something about the firm, either its patents, its know-how, its way of running itself, its superior governance, its brand name and reputation, makes those assets more valuable within that firm than in something else. The other characteristic of entrepreneurs is when they're starting out, you're seeing a very rapid growth in value in the early years. So for new ventures, there may not be any revenue stream at all coming in for 5 or 8 or 10 years, but that is coming later. So the firm asset is what you might call an appreciating asset. Unlike other assets which depreciate over time, this one is growing over time. So what is entrepreneurial income? And I'll give you my spin on it. The traditional way we look at income is labor returns to work effort, and capital income, which is the return you get for waiting for financial investments, a return for waiting, and a return for taking some risks. The entrepreneur's income is a mix of both. The creative effort of the entrepreneur is really what is creating value, and that's a return to labor. But since that value creation occurs a long time before there's actually any revenue coming out of that value creation frequently, the entrepreneur is getting a lot of capital income also from the buildup on the wealth, the return on her so-called sweat equity. I'm defining the entrepreneur income narrowly. Entrepreneurial firms also require an infusion of financial capital. Often the entrepreneur is supplying that as well. I'm trying to separate that out from the entrepreneur's sweat equity from this other financial capital, which could be supplied either by the entrepreneur or by external sources. Similarly, people who start companies often spend their whole lives running those companies, but I'm considering the entrepreneurial function just the startup function and view the entrepreneur as somebody who starts a business and then transfers it to some professional manager. As Bill will say, the special talents of people in starting growing is an important part, and taxation may impede the transfer from the startup to the mature operation. So if we look at slide 1, I only have 2. Is there a clicker? Or?
You apparently have the... Oh.
On my seat.
Oh, yes.
Okay. All right. Whoops, I just turned it off. No? Let's see. Oh, there we go. So one part of the taxation of entrepreneurs is the taxation of the buildup of new firms. And I would contend that in this segment, the taxation relative to norms of consumption and income taxation, the tax system favors entrepreneurs, and it favors them in 2 ways. One, the income is during the buildup phase of that wealth is not taxed. So if you were investing in a financial asset, you'd be paying tax on the return every year. In this case, you're not paying tax. And the other thing is when that income, the return to the sweat equity, is taxed, it's not taxed at the ordinary income rate, it's taxed at the capital gains rate. So both the deferral and the capital gains supplies a benefit to entrepreneurs relative to both an income tax or even a regular consumption tax that doesn't tax income from capital. However, there's another side of that, and that is the taxation of entrepreneurs, I contend, is also affected by the taxation of mature firms, because the firm that's being created is paying income tax. That firm's market value is going to be worth less than it otherwise would, and so as a result, the reduction in the value of that firm because of the future taxation is reducing the return to the entrepreneur, and that should be considered part of the tax burden of entrepreneurship. Now, I go through in a paper I wrote all the different determinants of what that tax rate is. On the wealth buildup, the tax rate rises as the capital gains rate goes up, also, but it falls if you have a longer gestation period and a higher discount rate, because if the capital income part is bigger, that's the part, the accumulation, which is exempt from tax, the deferral. For the ongoing firm, it's a little more complicated. If you have a higher effective tax rate on capital income, that translates into a bigger burden on entrepreneurs. Higher tax rate on capital gains and dividends does. A higher equity premium does. But going the other way, if the marginal tax rate on interest income is higher, or the bond rate is higher, that actually raises the opportunity reduces the opportunity cost, because it basically rather raises the opportunity cost, and therefore, that reduces the after-tax returns, increases the return from just investing in bonds, and therefore makes it more valuable to invest in. I'm getting this all mixed up, but to summarize it rather quickly, you can have, there are two things involved. There's the way that the corporation is taxed, and there's the discount rate that the corporation faces. And taxes can push that valuation in either direction, depending on some complicated factors. So I'm going to just make a few concluding. We can talk about more in this discussion. The taxation of entrepreneurs depends on two things: how you tax the buildup of wealth in the early phase, which is preferentially taxed, and how you tax the business enterprises that the entrepreneur is creating, which adds a second layer of tax. So there are many policy levers that might affect the tax burdens on entrepreneurs. It's just not a unidimensional thing. And so I conclude with the question, does it matter? And I guess there are, and these are two things which I have not discussed in my paper, and I think the panel will discuss more. One, how much does this tax burden actually affect the willingness of people to go out and start a business and take a risk? And that's certainly an empirical question on which some people have given some thought. And the other side of it, of course, is that lower taxes on entrepreneurs, since much of the wealth of this country, or much of the inequality in wealth, comes from wealth that was built up by entrepreneurs that they appropriated to themselves. So partly that the favorable taxation is increasing income inequality. So we have this traditional issue of, do we care more about the income inequality, or do we care more about kickstarting incentives for more entrepreneurial activity, and how effective is that? So I will turn this over to Susie.
Thank you. May I have the clicker?
Sure.
Thank you. So hi, everyone. It's great to be here at this terrific panel today. I always think about my own experience working for entrepreneurs when I think about the issue of entrepreneurs and tax. So this is going to go back to the firm which was not before named when Jean introduced me. But it was Wilson Sonsini, where I worked in Palo Alto from 1999 to 2006 or so. And what a huge shell shock it was to go and work there instead of at Ropes and Gray in Boston. And especially in 1999, one would get dizzy from the rate at which the reverse triangular mergers crossed one's desk. It was crazy. And it was a totally different perspective on how people thought about law, including tax law. The general impression was, the people who are your clients hardly have time to visit the restroom. How do you expect them to spend time thinking about tax law? And so it is kind of from that starting point that I proceed with this project and other projects. I grew up in the Northeast. I now live in Texas. I love Texas. So I'm not necessarily of a Silicon Valley in sort of the sense some people are, but it informs where I come for this project. So I want to share with you just one single image. It's here. I think if I click further, I'm going to get a little bit more info on this slide. But what this slide represents is the chance that a startup will succeed. So note that on the vertical axis of this graph, it only goes up to 20%. You have to kind of imagine it going all the way up to 100% toward the ceiling. And then the wedge of startups that succeed, in this case, the proxy for it is receive outside funding or venture capital funding, is in the neighborhood of 4%. The percentage of startups that make it from VC funding to IPO or strategic exit is in the neighborhood of 25%. So that's 1% for a success rate. If we are talking about the kinds of innovative businesses that people often think about when they think about entrepreneurs, those that are really swinging for the fences, they want to make a difference in the way something is going on globally, that need outside funding to do it, that are willing to take on a lot of risk to make it happen. So those are the startups that don't succeed in that kind of big, huge chunk of my graph, and the startups that do succeed are in that little skinny version, that sort of little bit at the bottom. So I want to use this observation to make two suggestions to you that perhaps have policy implications. And the first is that when we think about incentives for entrepreneurship, let's say tax incentives, one thing we should think about is that at least some of the folks that we are trying to influence have no time and also have very little money. So that, for instance, if we say, you know, let's have a patent box. We're going to have a patent box, and if you meet this list of requirements, and your company comes in, you register, and you fall through all these hoops, and then you can have a lower rate of tax. My point is, a startup is not going to take that deal. Why? Because it costs money to check all those boxes. They don't have money, and they don't have time. Eric Allen and I, my co-author at USC, did a study that used some empirical data to kind of show that line that you see on the bottom, which is kind of the likelihood they'll receive funding aggregated with each successive month. And then we considered whether a startup would spend $30,000 to eliminate income tax forever. No. If they have $100,000 or $150,000, because the $30,000 is better spent buying them more time to increase the chance that they'll get venture funding. So that in this resource-constrained world, and you do have to assume that the equity comes in successive chunks and that you have a limited budget at any time, but in that zero-sum world, there is, in many cases, it is just more sensible to spend money on business survival and product development than it is to spend money on tax. So one takeaway from this graph I suggest is, if we want to do things to help entrepreneurs, let's make them cheap and easy. So that's one takeaway. The second takeaway I want to propose to you from this graph is that if you think about the population of entrepreneurs that are out there, if you take as the premise that I use in this presentation, which is that we're talking about the ambitious ones that want to do something innovative that requires a lot of capital, that changes something globally, then you're talking about a population that mostly has losses. And so while it's possible to tell a story about why a startup entrepreneur would be influenced by a lower rate on profit, it has something to do with they believe they will have profit. And they see the kind of lower capital gains rate, for instance, on founder stock, and find that mentally very attractive. It's nevertheless true that if we have some subset of rational actors, what should motivate them is the treatment of losses, not the treatment of profit, because there is some chance that even if you have a really, really good idea, a very big chance actually, that it's not going to get picked up and that you're going to be left with losses. Some people who've looked at this question have said, well, let's just have loss offsets, a negative income tax. I had a wonderful experience just yesterday at Duke Law School where I gave an idea a little bit like this, and the students very quickly said, the 1980s tax shelters weren't so good, and we need to be a little bit hesitant before we go giving full loss offsets for business losses. There are some pitfalls there. Agreed. I mean to make only a narrower point, which is that if we care about these folks, if this is the clientele of a policy, we should simply recognize that they're loss-making in large part. And with that, I'll turn it over to Bill.
Susie. A couple of general observations, and then I'll turn to some specific observations about taxes and capital gains. When you think about the title of today's panel, Are Entrepreneurs Overtaxed? The first question that comes to my mind is, compared to what? And when I think about entrepreneurship, I can think of it in two different ways. One is that entrepreneurship is an occupational choice, and the other is that it's a business investment choice. And these two things are tied up together. And as Eric was suggesting in some of his comments, this makes us as economists start to want to think about, well, what's the return to the labor component of that, and what's the return to capital Those are really, really hard to tease apart, and there are a set of tax proposals that really do ask people to try to separate the different types of returns. Some that we're thinking about in the U.S., but also what are referred to as the dual tax systems or the Nordic tax systems, where there's an idea that since capital is more mobile, capital gets a lower tax rate than labor. So you have to split the world, and when you think about an entrepreneur, splitting their world into the labor component and the capital component is difficult. Second point, overtaxed actually has two different elements. This is going to pick up on something Susie was talking about. There's the level of taxation, and then the asymmetry in taxation, the difference in how we tax the unsuccessful versus the successful entrepreneurs. And as Susie said, some people would advocate for full loss offset sorts of provisions. And in a perfect, whiteboard sort of world, economists like those proposals because it basically says the government is taking the same percentage of the upside of the project as the downside of the project, so it's not kind of distorting the project. One trick there is not just to think about this asymmetry from being in our tax treatment of capital investment. For entrepreneurs, it's also true that it's the treatment of the opportunity cost of their time. Mm-hmm. And that turns out to be about the progressivity of the income tax and the portion of labor income tax. For example, if you instead of taking a job getting paid $150,000, you become an entrepreneur, you might be writing down very low labor income for several years. And how much that costs you after tax is a function of the progressivity of the tax system. The third point, and this touches on Eric's comments as well, that it's a complicated combination of individual taxes and entity-level taxes that matter. The individual level taxes that matter aren't just during the ownership, but also, as I'm going to talk a bit more in a minute, the transition of ownership from the initial owner to who's going to take the company over. In other words, the capital gains tax. The entity level taxes, again, while it is owned by the entrepreneur, but even more importantly, in some of Eric's work, it's the taxes on the entity post-disposition by the entrepreneur. For if you sell your business, you might say, well, what difference do the taxes after I sell it make? Well, the answer to that is what price are you going to get for your business is going to depend on how the future owner is taxed. And that heavier their tax burden, then the lower your price is going to be, and that's going to matter for how taxes are going to affect your incentives, whether you want to be in this business or not. The fourth area to think about, the fourth general point, are compliance issues, and there's a host of compliance issues to think about. Joel Slimrod's talked a number of times about the fixed costs of compliance. Adding a zero to the revenue and cost columns in your tax return does not multiply the cost of compliance by 10. And so smaller businesses end up with a high average cost of compliance. The second countervailing effect in compliance is that in many places we think of the small business sector, and sometimes entrepreneurs are in that sector and sometimes they're not. We can quibble about what that means. But we think of the small business sector as the informal sector, and that opens up issues of tax evasion as well as just the simple idea in the small business of navigating the distinction between business expenses and personal consumption, which can be a way of pulling tax advantage consumption out of the firm. Turning to the capital gains taxes in entrepreneurship, one thing that I did some work, it's published in the Tax Law Review last year, and I looked at the empirical significance of capital gains associated with active business assets. And so I turned to the Federal Reserve Survey of Consumer Finances from 2013. It's a household survey that does a great job of capturing the portfolios of Americans. It oversamples high-income people. That's a good thing when you're thinking about wealth. And a couple of things came to mind. Active business assets are an important part of household portfolios. It's about 17% of household wealth compared to direct ownership of stock, which is about 12%, and housing equity, which is about 20%. So it's a large part of what's going on in household portfolios, but it's highly concentrated in about 10% of households. So not everybody has a small business. The third thing is, because we're thinking about capital gains, the issue is, well, how many capital gains are there? And in prior data, people have looked at the realizations and in the Treasury data, And you might think from that data sometimes it doesn't seem like a lot is going on the, it's more stocks and publicly traded stocks than small businesses. But in the SCSF data, there are considerably larger unrealized capital gains in the small business sector, active business assets, than in direct ownership of stocks. So that means that the fact that there are a lot of capital gains says that taxes could matter for these capital gains and their realization. I would say that there are three different things to consider in how capital gains taxes would matter for entrepreneurs. They're the same three margins that we think of when we think of capital gains taxes and owning stock, or for larger corporations. One of them is that it affects people's portfolios. So the classic example of how the capital gains tax affects portfolios is through its realization nature. It's a tax on the transaction. So if you're sitting on a large capital gain, you have an incentive to defer the capital gain realization. There's a lock-in effect. Now, if you lock me into owning IBM stock because it's had a good run, I don't think IBM's management cares. Somebody else owns their stock, I own their stock, same decisions made. The same is not true when it's an entrepreneur who owns their business. And this is the point Eric alluded to earlier. If this is delaying when the company is sold relative to when it would be sold without this distortion, then this basically says we're not getting the companies to move from the best possible to the best possible managers. And so that lock-in effect could actually have a bigger real effect than we think of in the sense of portfolio investment. The second thing we think about with capital gains taxes would be risk-taking. And with risk-taking, again, we could think of it in the context of a stock portfolio. But the most important thing to think about there is that in some sense the capital gains tax has an insurance element to it. And as long as I have some capital gains and I have some capital losses because I invest in a portfolio, then I'm going to offset the gains and losses. And it's not at all clear that a higher tax rate leads to less risk-taking. In fact, traditional theory suggests it might be just the opposite. This comes to Susie's point. It really is about the losses. It is also about the gains. It's about the relative tax on the gain and the loss. And so if we're taxing the gains but somehow not taxing the losses because those are the businesses aren't going to be sold, then this asymmetry could be driving a substantial burden. And the third area would just be the cost of capital. That the capital gains tax is part of the capital income tax system. And so it would be an element in the cost of capital for new firms. And that's true for both publicly traded firms, but especially true for startup firms because they're seeking external finance as opposed to being a mature firm and using retained finance as their form of equity finance. So with that, I will turn it over to Donald.
Great, thanks. So hi again. So I'd just like to echo and reinforce some of the comments that my fellow panelists have made. As way of background, I should note that back in the late 90s into 2000 and 2001, I was actually over in the entrepreneurial world. I was chief financial officer of a health IT startup down in Austin, Texas, kind of in the peak bubble years. After that, I took solace in a government job. But from that experience and then from advising some startup companies in the meanwhile and doing some angel investing, I'd first just like to echo what Susie said before about when you think about the people who are founding startups, things that are very, very precious for them are time, neurons, and money. And so anything in the tax system that takes up their time, their neurons, or their money is problematic for them. And so one way to think about the tax system possibly doing things that could discourage entrepreneurship is any difficulties on that front. The second, something that both Susie and Bill talked about, was this issue of losses. So again, you think about many companies when they start up, hopefully they get to some revenues relatively quickly, but it's very likely if they're on a fast growth trajectory that their costs are going to be larger than that. They're going to be making losses in their early years. If there's something really ambitious like a biotech startup, right, the losses might persist for a decade. And as has been discussed, the tax system just isn't symmetric about that, right? So Uncle Sam is very happy to partner with you quarter by quarter and taking a part of your upside when you're making profits. But Uncle Sam is not writing you rebate checks every month against your losses. If you're a large established firm where you had profits in the past, sometimes if you fall in a loss circumstance, you're able to take advantage of those losses immediately and get a rebate on what you paid before. But if you're a new, young venture that's just getting off the ground, that isn't an option for you. And so there is a cash flow effect and an ultimate tax burden effect of not getting full credit for your losses. And then in addition, if you're a startup, you face a second challenge, which is that the normal state of affairs is that you have the ability to carry your losses forward into the future and lose them later, and so you're just losing the time value of money, okay, which is really valuable if you're a startup because money is tight, but still you're getting it back someday. But there are also some rules where the tax losses just disappear if you get acquired or do a large equity financing. And so for young startup firms that aspire to be acquired one day by a larger firm, this is actually a significant financial penalty. My colleague Joe Rosenberg here in the front row and I did a paper on this a couple of years ago. We ran through the effects of that on incentives to invest, and it's really quite substantial. Now, the challenge is any way you try to fix it raises the issues that Susie raised, which is that creative lawyers start creating things that look like tax shelters and not like go-go startups that we want to encourage. And so you have to find some sweet medium in there. But in principle, that's an area that one could fish around and think about ways to make life easier for entrepreneurs, along with, as I think Bill was hinting at, things that just reduce kind of the compliance costs for young firms. The other thing I'd like to emphasize is something that Bill also mentioned, actually Eric hinted at as well. Very often tax policy discussions focus on individual actors in a transaction. So the entrepreneur or the employee or the investor or the firm. But very often it's useful to think about a more global perspective where you ask yourself, what are the taxes on each person participating in some way in the transaction, and what is the net of all those together? And that you might be able to accomplish what you will want to accomplish through tax policy by making sure that you get both sides of a transaction done right. And maybe if you're taxing entrepreneurs hypothetically too much in one regard, but you're taxing their companies less over here, or vice versa, maybe it nets out. Now, maybe it doesn't. But it's useful to think about the whole chain, not just the individual piece. And as an example of that, I wanted to highlight the discussion about carried interest. Quick show of hands. How many people in this room know what carried interest is and what the debate is? OK, so running around half. So venture capitalists, private equity firms, professional investors, and also some non-professional investors often have arrangements with the people who provide them capital that they'll invest in startups, they'll invest in fixing a broken firm, and they'll get a piece of the upside. And in the canonical simple case, the way the upside is returned to them is through capital gains. And so the venture capital fund managers and the private equity fund managers who do these things end up having a part of their reward for doing a good job being capital gains that they then pay lower capital gains taxes on. That's controversial for a whole host of reasons I won't go into in depth, except to note that one of them is, wow, this return to this activity looks a lot like compensation. The venture capitalists, the private equity guys are working hard. They're creating value. Right? Shouldn't they be taxed at ordinary rates like everybody else? We could have that debate. But the thing I just want to highlight is if you go down that route, there is one sliver of the world in which you end up increasing above normal levels how much you're taxing entrepreneurial activity. And that's in instances in which private taxable investors are providing the capital that these managers are using. It turns out this is not true when it's tax exempts who are providing it. But when you have a taxable investor who's providing the capital, and then you're hitting the manager if you change the way carried interest is treated, if you tax carried interest at ordinary rates, you have on net increased the tax burden on the financing go to entrepreneurial ventures. And that's a real phenomenon. But I just want to emphasize that if that concerns you, that doesn't necessarily mean you have to be opposed to taxing carried interest as ordinary income. Because the other thing you could do is think about the investor side of that equation and say, is there something we could do to change how the tax treatment of the investor side of that so that the overall package is being treated the way we want? In a recent paper, I walked through the logic of that and just point out that as long as you give the investor an appropriate deduction for the carried interest that's being paid to the manager, just like you do to investors when they pay people to do other investment services for them. There's nothing weird about this. It's just applying the normal treatment that you give when people pay for various kinds of investment services, that on net you end up in the right place. And again, right, we could discuss carried interest or not today, but the point that just illustrates the point that when you think about changing the tax treatment of a particular part of a transaction, it's important to think about the other players in it and think about the net effect of all of those together and how they aggregate up, and not necessarily just focus on a particular piece. Thanks.
Thank you. So now I have a million questions, none of which I came with, but whatever. We'll mix and match. I think just up top, can each of you just grade today's tax code in terms of how it treats entrepreneurship, not just the individual, but the firm, the investors, the workers? Just broadly, because since everybody wants to overhaul it. Where are we today?
Well, I think on a rough term, we have a moderate subsidy to entrepreneurship relative to other uses of either work effort or capital. Whether it's the right amount or not, I can't tell.
I guess I agree with that on the profit side, but on the loss side, I'm not sure. So I might be, I'm confused whether we're on today's grading curve or the grading curve of 20 years ago. But maybe I would go down 2/3 of a letter grade from wherever you are.
What was your letter? Did you
I
get a letter?
didn't. I didn't.
A C plus?
B plus.
B plus.
Okay,
Okay.
B minus.
All right.
I'll go with a B. That makes it easy. I shared Susie's concerns about the tax treatment of losses and the asymmetries in the tax system. I think some of the pluses for the tax system right now is the tax rates are not ridiculously high. I mean, so if you compare, at least on the personal side, the corporate side, different kettle of fish. But at least on the personal side, they're not incredibly high tax rates. So it could be better. But
It could be.
I guess I would add, though, on the corporate side, I think they're actually not that high. It's the statutory rate is high, but what matters if these successful firms have IP and can shift the income, their effective rate's not that low, and that's really what counts in terms of the valuation.
True, but sometimes that statutory rate's what's creating some of the worst incentives for doing funny things.
Oh, absolutely.
So,
yeah. No, it's bad in other ways. But
bad in other ways, but.
So I guess I got to go with a B, but based on the standards that held when I was in college, and whatever that may be.
That real
that might be an
standards,
A or A plus today. No, no.
Yeah.
No. Great
Again,
inflation out there.
just to bring the conversation up from the technical for a minute, I am really confused who the entrepreneur is. And no, really seriously, people talk about small businesses like they're entrepreneurs. I'm going to open a restaurant, I'm an entrepreneur. I'm going to come up with the smallest microchip ever, I'm an entrepreneur. Are they the same things? I need investors too to open my restaurant, but I'm not really innovating, I'm just feeding. So how do you define? How do you think lawmakers should define? I mean, I'm trying to keep the questions in the context of tax reform. So as lawmakers go into this, if you believe that entrepreneurship is important to the economy, how should the tax code distinguish the small business restaurant owner who just opened her place with the small microchip creator who is going to make a mint?
Well, maybe the policy rationale for worrying about whether entrepreneurs are adequately supported has to have something to do with some public good that we think that they're providing that they're not being compensated for somehow. So if that's the case, then I'm kind of less persuaded by the Thai restaurant or the new restaurant, and more persuaded by the swing for the fences innovation on the theory that the good public thing that we want to support is some kind of life-changing innovation that we haven't even thought of yet, some kind of great medical advance, some kind of productivity advance that really boosts the economy. You could argue, I suppose, that the small businesses are providing the public good of more jobs. I don't know. Medical schools do that too. So I'm a swing for the fences sort of person on this.
So swing for a fences person with a brand new product innovation, cool idea.
Yes.
Okay.
I guess I would agree with Susie, but I guess I would say these are really two different things, both of which you might think are valuable. So you might actually think it's valuable that we have small and independent businesses operating in this country from the point of view of the culture and the political culture and the society, without calling them entrepreneurs or not thinking they produce the growth benefits that entrepreneurs do. Now, those are really separate questions. I think you need to worry about both.
But from tax policy perspective, are they taxed similarly? In other words, are they subject to some of the same provisions?
Some of the same provisions, but I think you would analyze their taxation differently.
I agree.
I think I would think of this as two separate issues. I mean, one is innovation. And innovations can take place in small businesses. Innovations can take place in really big businesses. And so to the extent we want to worry about innovation, we should think about tax policy towards innovative things. R&D credits, for example. Not endorsing that, just saying that it would be neutral between large businesses and small businesses. One of the tricks here, and this comes back to something Donald said in response to one of Susie's, is the comment he made about when you're a big firm and you undertake some risky drug trial, if it fails, you just sweep that into the portfolio that has all the successful ones, and your losses are getting offset against your gains. And when we have small businesses, if you're only doing one drug and it turns out to be a dud, you might never get any tax write-off on that loss. And so there's kind of a question of trying to be neutral between whether the innovation is in big businesses or small businesses. On the small business point, kind of the things that you might think of as not as innovative, I think, again, I'd look for neutrality between different ways we can have Thai restaurants. And as someone from a very rural place, I don't mind saying a few more restaurants and a little more variety where I live would be just fine. But I don't know that I want to say, gee, it needs to be mom and pop versus a chain that has 20 restaurants or something. We don't have chain restaurants in Williamstown, Mass. So.
Yes, I guess the distinction, so there is this really crucial distinction between small businesses and what you might think of as young growing businesses, along with, of course, the additional point that sometimes entrepreneurial things happen at Amazon or some company that's been around for 20 years. But so you clearly want to distinguish the small from the young and growing. For the small, the really important, I think, significant issues there are the compliance issue that Bill mentioned, that just complying with the code is hard, and so things you can do to make it easier, using cash accounting rather than more complicated things like that can help them out. But you have to temper this also with the reality that if you get into the part of the world that is small businesses that are cash businesses, you start running into some compliance issues. And so there's kind of, depending on what goes on, you basically have a situation which is the completely legitimate small businesses bear a lot of burden from compliance, and the not-so-legitimate small businesses take a bunch of cash home at night and don't pay their fair share. And so finding a way to balance that. For the young and growing, and we've already touched on these, for the young and growing businesses, they're very often going to be in the position where this loss issue is important for them. And so thinking about the loss issues we've talked about may be a way of helping them out. And then they're also, in the state of the world where they're successful, they're also the ones that obviously are getting into large capital returns, either for their outside investors, their employees, or their founders. And the tax treatment around those may be a relevant lever for thinking about them.
So,
I guess I would like to add that I don't really accept the distinction that linking the entrepreneurship to necessarily the technology. That I remember hearing Steve Forbes speak some years ago, and he was describing a great entrepreneurial company called Starbucks that made coffee. So, I mean, what can be so plain vanilla and ordinary as that? So I think it's, it's something, you find a new market, you get a new product, you get a new way of doing things, you open up, even your national chain of Thai restaurants might qualify in that sense, if areas are underserved by Thai restaurants.
Indeed, if it were risky enough. And some people think that the best proxy for entrepreneurship is risk, and the best proxy for risk is loss, which brings us right back to that point.
Unless they win.
Unless
they don't have losses.
But still, some substantial proportion of people would have losses.
Yes.
Firms would have losses.
well, so between the two of you, I got the sense from you very clearly that people who are really excited about doing something and are really at the very early stages, they have no time for tax policy discussions or tax planning. I got the impression from Bill that it's very much a business decision whether to even enter the field because of the tax bill.
Right.
And just my personal bias is I agree more with her that if you're really excited about doing something, you have something that's innovative, the tax piece of it, eventually you'll think about it once you're really established, but tell me why I'm wrong. There's so many reasons I'm wrong on so many things.
No, I mean, it's a question of, you can always ask the question, do taxes matter? Well, what do they matter for? I mean, I think that if we have really, really high tax rates on certain types of activity, then people aren't going to undertake them. I mean, I think if you just jack the tax rate up high enough, people are going to say, I could go do that. But it's also true, if it doesn't work, I'm not going to make anything. So why don't I go off and be a college professor where there's a nice, even stream of income? It might not be as high, but it's kind of a nice life.
But we're not high now. You don't think rates are particularly high now?
I don't think they're particularly high now, but then we're arguing about the degree of magnitude. I mean, so the question is do you go live the nice life or not? I mean, So you could also ask questions of how has entrepreneurship changed over time when we used to have higher personal tax rates than we have now. And so particularly getting the rates down could help. Now the question is, do we need to get them even lower? Maybe not. Maybe they're in the right range. But I'm a little skeptical of just people completely ignore the taxes, if for no other reason, just that the tax bill that they're paying right now in their job has to do with what's it mean to leave your job.
Right. Okay. Donald, you want to say something?
And one thing, just to drive home the point made before, is I think it's also important to think about the multiple sides of an entrepreneurial venture. And then certainly when you think about the most promising ventures that are going to get venture funding or private equity funding, the venture folks and the private equity folks who are professionally in this business have both a professional interest and the time and the resources to think really, really carefully about the tax stuff. And I will confess to you, some of the most sophisticated conversations I've had about tax issues have been with people who are private equity people and venture people, because they've thought about it. And so it clearly, has some influence on how they structure their behavior and how they think about it. And so that may be a channel through which it influences what happens at the new venture level, even if the entrepreneur themselves is too harried really to think about it.
I think you do see some of that. Sort of for a while, the line from the venture capital industry was, it's all about speed. We want C corps because they're fast and easy. And so, but I think that more recent interviews that I've done suggest that there's less of a focus on that. It's like, oh yeah, LLCs are all right. We'll take an LLC with sort of the increased tax complexity. We get that there's some advantage to that. And there are even some anecdotes about certain investment funds requesting that a particular portfolio company, for example, put into place an offshore structure. Now, so my view on that is that is increasing. That the industry traditionally has been kind of I think one joke is it's kind of got this, A+ tax optimized structure for the fund and kind of a Mickey Mouse structure from a tax perspective for the portfolio company. But I do think that over time that's changing, and I bet that soon if we look at the empirical data for the firms that venture capitalists invest in, you will be able to see a trend upward in the percentage of LLCs. I don't know of any data out there that's there, but I think that will happen.
Did you want to say something? No. So let's talk about the House blueprint without too many specifics and the Trump, the latest form of Trump's tax reform plan. And maybe Eric can speak to this most directly. In your paper, you seem to indicate that in terms of an effective tax rate, that entrepreneurs, as you define them, would do way better under the House plan than under Trump's plan, even though they would both do better than under today's code. Is that fair?
Yeah, I'm not sure I agree with what I wrote about the House plan anymore, but I do think the rationale for that argument was that the House plan was reducing the effective tax rate on new corporate investments to zero. So if you look at that as a very favorable, that would be more favorable than the Trump plan. Then if you look at the House plan that it's taxing the supernormal returns and doing that effectively and getting rid of interest deductions, it may actually be raising, by raising the cost of borrowing, reducing the value of firms, and therefore taxing entrepreneurs more at that second level. So it's a mixed bag. I actually don't know what the answer to that is.
Okay.
There are a lot of moving parts there. I think both of them probably because they're reducing the capital gains rate and increasing that preference a bit are helping relative to current law. There's another factor which is in the Trump plan particularly, which is this 15% rate for business income, which is certainly helping ongoing small businesses and entrepreneurs that become large partnerships because that rate is lower. And there the question is, I think it really does significantly reduce the rate, but one of the issues is at what cost, because this is a very, very big revenue drain to the Treasury, whether that's a cost-effective way of doing it.
Do you all philosophically think the tax code should be in the business of spurring innovation and supporting it, or more just not getting in the way? I know that's a subtle distinction, but it is because I mean, you all gave it in the B range as a grade today, in today's code, which is not awful. Like, you can get through life getting Bs, right? It's not awful.
Even today.
Even today, right. So philosophically, do you think that's how lawmakers should think about this? And then specifically, if you had to give 3 recommendations to the tax writers in the House and the Senate today in this, oh, look, he's looking exasperated.
3 is a big number.
3 is a big number? Okay,
Oh,
give
yeah.
me one then.
1, 2, 3.
Oh, so I'll take a crack at the innovation piece. So I would say my view is, the first step you want is a tax code that's as neutral as possible across things. But then you have to decide what things you think the government ought to do. And I find the case for encouraging innovation and the development of new ideas because they spill over. I find that a very compelling argument. And so I believe we ought to have policies that do that. You then face a tool question about what is the right tool to do that. And you can do some of that through intellectual property rules. You can do some of that through spending, right? NIH and whatever. There's no rule of nature that you have to do it through the tax code if you want to encourage particular types of activity. But either for political or administrative purposes, that is sometimes a convenient way to do it. And so I'm fine with doing some of that through the tax code, right? And things that try to encourage, but trying as best as you can to focus it on the cases where there's a legitimate, plausible case that there are really spillovers. And that, and I believe that when people innovate in terms of business models and in terms of ideas, that you do get those spillovers. But you want to target that as much as you can.
Okay. Bill, do you want more time?
Oh, I'm still. Actually, I agree with everything Donald just said. I find that, I guess the thing I would add is I find the tax system to be a somewhat blunt instrument to think about innovation. I think things like intellectual property law and getting the incentives there. Just think. For a patent, you have to show that something's new and non-obvious, and we've got a patent office and it thinks about these things. And if you put that in the hands of the IRS, then either you have to recreate something like that, or you're just, giving incentives for things that aren't new or non-obvious or even helpful. I think I would kind of come down on the side of try to keep the tax code fairly neutral and use other policy levers for spurring innovation.
Okay.
So I guess the tax system is, in general, I agree, a second best solution. My favorite government innovation policy is the funding of basic research, just the direct funding of basic research. Mm-hmm. I guess the argument people make for using tax policy to support innovation is that there's less of a requirement that the government define innovation. So that the patent system has to define what a new patentable invention is. And the tax system can kind of piggyback on what people in the private market think would be a good idea. Right. So it can kind of harness that, and that's the advantage that it has. So I guess if we, there's a little bit of a difference of framing. Some people might say, loss offsets are just a piece of what you are to do to have a theoretically correct income tax in the first place. But whether you view it that way or you think that something there in the way of using refundable tax credits or somehow otherwise giving benefits for losses is a departure from the way we currently do things. I guess that would be my second best choice after the funding of basic research.
After the refundable tax credits. Mm-hmm. Yeah.
So my only comment, Jean, is I share everybody's view. I'm always like neutral taxes and taxes that don't interfere with private decisions. Unfortunately, whenever I've gone through tax designs and looked at different options, nothing is ever completely neutral. There's no way you can make all the margins equal until you get stuck with capital gains being a good example, where at one level you're undertaxing them because you're taxing them less than ordinary income, but then you're imposing the tax at the time when the entrepreneur is deciding whether to go public or not, where if they don't go public, there would be zero tax. In which case, you're creating a distortion or a discouragement of that particular choice. So I kind of find myself on the side of some preference for capital gains income. I'm not sure exactly how big it needs to be. But some preference relative to ordinary income for the lock-in reason, and I think the lock-in reason is particularly important, as Bill said, with regard to entrepreneurial ventures. But that's different from saying, that's more from not wanting to put barriers and not from a philosophical point of view that the government has decided. It's one thing to say entrepreneurs contribute a great deal to the economy. It's another thing to say we should actively try to subsidize them, because we may actually get the right amount of them. As Susie says, a lot of them fail, and there's a lot of wasted effort there.
I don't know, wasted, it's creative
Well,
failure.
creative destruction or creative
Right.
non-construction or
Learn
whatever.
from your mistakes.
That's right. That's right.
I did come up with something we have not mentioned about small businesses. It may or may not be about entrepreneurship, but it's certainly true about small businesses and the occupational choice decisions. It comes down to how we finance healthcare in the United States. For small businesses, health insurance is a different creature than for very large businesses. And so if you want to go out and start a small business, and then hire 10 employees or something, having health insurance for those 10 employees is a little bit trickier than if you are a company with 10,000 employees. And we have a tax code that has promoted employer-sponsored insurance. So if we're going to do that, and then we want to even think about neutrality, how do we do that for small businesses? Well, one could claim that we might currently have some laws that are pretty good about pushing people into community rated plans and mandates and a few other things. But we should worry about that as we repeal the ACA. that health insurance is an incredibly important thing for people. And if you're in a small business, it gets really expensive.
So your view on the ACA and the repeal is what, specifically?
Well, let's
You
just
went
say,
there, I didn't. I was not going to mention healthcare.
well, the nice thing about mandates is that it kind of helps an insurance market form, and so, and that kind of says you could leave a business and be a small business and find your way into health insurance under the ACA.
Okay.
So that actually is kind of a way of making it easier for people to become small business people.
Okay.
So that's.
Do you want to say anything? No, you're good. I was going to ask for questions from the audience or from the online audience if anyone's emailed anything in. We have 2 mics that are coming around, so just raise your hand and offer your question. Howard Gleckman.
Hi, I'm Howard Gleckman from the Tax Policy Center. I wanted to follow up on this issue of tax treatment of losses. So you've all said that that's the sort of the critical issue. And Susie, you suggested that maybe refundable credits. But I wonder if you could each talk a little more about how one would design a provision of the tax code that would help out these companies, help out their cash flow in some way without generating the kinds of abuses that sort of easily come to mind. Any more thoughts about how to do that?
So we have an existing model that is far from perfect, but let's maybe just put that on the table, which is the way that we treat refundable credits for example, clean energy initiatives. And in that case, as I understand it, you give credit for some percentage of expenses. We understand that the company who spends money is going to be a loss company and therefore can't itself claim the credit. So there's guidance that signs off on the use of partnerships to assign the credits to money partners who can use them. So that's one existing model. And one interesting thing about that is that there's been a selection of, an area where we say, we really need more technology in this particular area. We think that this is a really big spillover potential area. So we're going to carve it out. We don't really want to go with a direct refundable credit tax loss offset for that firm. So we're going to do the tax credit partnership structure. So the partnership structure is expensive. Not all the benefits are captured by the firm. There are issues with that, but that's the existing model. We might not use a tax credit partnership structure, but if we were worried about the full loss offset because we're really sort of anxious about tax shelter type issues. It offers also the possibility of identifying particular industries or needs. I'm not crazy about that, but I think that's the closest to the existing system that we have. I mean, yeah.
Obviously, I mean, the notion of trafficking and lost credits sounds almost like drug trafficking for some people. That's hard to make work. I mean, I think that's a challenging part of this. The first thing, the really simple low-hanging fruit, would potentially be to think about giving people interest credit for their net operating loss carryforwards. And just that will take out the time value of money issue of this. It doesn't solve the companies that just absolutely fail. So it takes a small part, it takes a small and easy step, but it doesn't solve the big part of the problem. The bigger part of the problem is trying to move the credits, as Susie's suggesting, from someone who can't use them to someone who can use them, and that can open up the floodgates to backing up the trucks to Treasury and driving off with the money.
We have a question in the back, and I just want to remind people online, if you want to send in your questions, you can do so to events@urban.org. Sorry, sir.
Yeah, I want to push back on this loss business a little bit, because I mean, for example, let's say you're a small drug company, and you're testing a new drug, and it's going to take you maybe 5 or 6 years, and each year you spend money on that, and you guys are calling that a loss, but I would call that an investment. You're investing in, I guess, intellectual property, which at the point when the drug either ends up getting FDA approval, that's great. If not, at that point there's a loss. But why are the expenses that are incurred by the drug company not an investment, just like if it bought some other piece of capital?
Oh, it's perfectly fair to call them an investment. That particular investment under tax law would be expensed. And so the real reason we think of them as losses is not the project level. It's that they would be in a negative income. Their tax return would say negative income. And we just call those net operating loss carryforwards. So that's... Well, you could. I mean, it is true. But even if you capitalize them, you would still put them in a position of having you're not giving them the refund, the proper refund that you would give them. I mean, if that's the only project they have going, you would say, okay, I made some investment, and I would start capitalizing that investment. So I'm going to have negative income. I'm not going to wait until, you're going to say I have to wait until I decide whether the drug was good or bad. When you start capitalizing from the very beginning of the expenditures, well, either you deduct it, but if you have no revenue yet, whatever you do, you deduct either the expenditure or a portion of the expenditure. You'll be in negative taxable income. And our whole point, the reason we call them losses, is that we aren't in the business of sending people refund checks in the corporate tax code. That's the problem. That's why we refer to them as losses. I mean, I think that's why the nomenclature is it's a loss. I mean, that's what's puzzling you.
I think what Victor's saying is the norm under an income tax would be to capitalize expenses like that, not deduction.
It would be, but you would
so
still
the deduction that other firms are getting, the bigger firms, is a subsidy. So you're not, but even so, you're still treating the smaller firms worse because they don't get the subsidy.
You're treating the smaller firms worse. That's the key point here, is that if you've got 20 other drugs going, you'll have some income to offset those against. We can have a discussion as to whether R&D should be expensed or capitalized. We've made that decision for all firms. It's expensed. You're right, it's not proper income tax treatment. It's perfectly fine consumption tax treatment. I'm okay with that.
We do have I'll come to you in 1 minute. We have a question from online from someone at Hamilton Place Strategies. Interest deductibility is critical for entrepreneurs, but current tax plans propose ending it. What impact do you think eliminating interest deductibility will have on entrepreneurs? Anybody?
I would think it's relatively more important for old companies than for new companies. In other words, to the extent that limiting interest deductibility hurts people, I would think it hurts entrepreneurs less than it hurts other companies.
Yeah, I think maybe the motivation of the question is that the House GOP plan is offering expensing and taking away interest deductibility, and most small businesses, whether entrepreneurs or not, get the benefit of expensing of their most of their machinery and equipment. So getting the extension of expensing doesn't help them at all. And they're being hurt by losing the interest.
By losing the interest deduction.
Yeah.
Mhm. Any other thoughts? The lady in the back.
So I have a kind of two-part question. One is, I think a B is a really good grade, and so I'm struck by the fact that you all gave around a B, so maybe a B minus, to the way we tax entrepreneurs. At the same time that it seems we're about to launch an effort to rewrite the tax code on the grounds that our tax code is broken. And so my question is, do you disagree with that premise, or do you think we're doing a really better job that the way we tax entrepreneurs, we're doing remarkably better than the way the rest of the tax code functions? And the second part is there any country that you know of that you would give a grade of A or A+ to in the way they tax entrepreneurs? Thanks.
I can't answer that. That was a good question.
I think when you asked the question of how we're taxing entrepreneurs, the way we were thinking of the question is the tax system somehow treating entrepreneurs properly relative to other industries, other sources of income? And on that level, we were giving it a B. I don't think any of us were providing an overall grade to the entire tax system.
Yeah, I agree
I
with
at least
that.
speak for myself. I think I can speak for everyone else here.
Yeah, I agree with that.
No, I think that's the right answer to that question, which that's the right caveat for what we graded, which is in the context of the overall tax system, what is our grade for the entrepreneurship portion? I suppose we could answer the question of what we think of the overall tax system.
Would you like to do that? I could ask that right now.
If one looks internationally, the big difference that the U.S. has is that there is no national level VAT, and instead there is an under-reliance on consumption taxes. So if one's going to make a comparison, it probably has to be on that basis. If we could find a country with a decent income tax and a well-functioning VAT that worked together in a way that beat out our federal division of labor on that point. So I'm not really sure what that country is, but I do know that New Zealand has the best VAT. They have a VAT that is the envy of VAT people. Very good VAT.
Did you want to answer, Donald? You're good.
No, I'm good.
Okay. There was a gentleman near Steve Rosenthal who had a question.
Jerry.
No, it's Jerry Otten.
Hi, Jerry Otten. A couple things. One, you mentioned that the entrepreneur might be too busy to read tax manuals, but he may want to get funds from family and friends to invest in his business before they get to the angel stage. And they might be quite interested in incentives that they know to be available. I mean, the word gets out that capital gains are a good deal or that there's some special tax credit. So even if they haven't read the manuals, they kind of know things exist. The other thing so thinking about the people who might invest in the business, not just talking about the entrepreneur. The other thing that is to remember the 1202 capital gain exclusion, which hasn't been mentioned. One can now, this was a big Obama thing, that small businesses would not be taxed on their capital gains. And the current is 100% exclusion on up to $10 million of capital gain, which is pretty generous. But there are very strict rules in terms of when it applies. Very complicated. At any
Jerry, is
rate,
that only for corporations, for C corporations?
that is for C corporations, so it's one of the things that would push people in the direction of having a C corporation.
It's hard to square that with the fact that people value businesses based on EBITDA. That's the piece I always come up against. How much is you selling your business for? X times EBITDA. So I don't know that people on the investor side think about that. I think that some do. Whether they're the market makers and the price setters, I'm just not sure.
Show of hands, how many people know what EBIT is?
I always have to look it up again.
Or revenue. They might, but
Yeah.
they would in
Just
a
a measure of
startup world say something times revenue, for instance, would be the. And then I think that certainly there's got to be something to say that, oh, clean energy is favored by the tax code. That does give it a certain kind of salient gloss. I agree with that. But I think it's hard to kind of quantify that. Lily has a question.
Is that Lily? Yes.
Oh.
Lily Batchelder.
So I had sort of maybe the opposite question from Mindy, which is I'm wondering if you're being too harsh graders. And particularly sort of listening to your ideas for changes, I was wondering if the grading was against a theoretically ideal tax system or sort of what's administrable. And in terms of reforms, I heard Donald mention cash accounting. There was sort of some discussion of refundable R&D credits, which they're now refundable. Maybe extending that a little bit, but then everybody seemed to think that actually direct spending on NIH or other innovation technologies or reforming IP laws would be better than the tax system. And then in terms of the losses, I heard you say we should maybe allow an interest charge on losses, but then we need to be careful about the tax shelter, and maybe we need to confine it to particular industries or activities, which then begins to sound like the R&D credit that a lot of people seem to think would be better done through direct spending. So I'm wondering if you're thinking of just the tax system and you have the alternative of direct spending, do you really think we have this all that wrong? Or is it even possible, given that we have expensing and interest deductibility, at least for small businesses, that we're taxing entrepreneurs too lightly rather than too heavily?
I totally don't have the answer to that.
I think you heard the consensus. I mean, I heard the same consensus that you did. Like, oh, gosh, it'd be great if somebody else did this work. It'd be great if we could have direct spending do this. I feel that way.
I'd like to be one of your students, Lily. That's all I can say. Give me an A for my imperfect answers. That would be great. I think it's hard for any of us to say any part of the tax code is perfect, but you're right, it can't be. So
Yes.
maybe it's, all things considered, it sort of mixes out. We give us a big subsidy, at least in my way of looking at the world, to the build-up, but then we tax the corporations, and maybe having 2 levels of tax is really the best we can do, and they add up to something close to right. I'll take your point. But we are very reluctant to give anything about the tax code an A.
I agree. I mean, I also wonder about one comment you made, Lily, which is that somehow if small businesses have expensing and interest deductibility, then we're not taxing them very much. That might be why I'm not giving them an A, because actually that's not a coherent tax, by the way, folks. An income tax, as Victor was saying, would not have expensing and interest deductions, and so that's a problem. It's not a feature. That's a bug. You're right that in some sense we're grading against the theoretical ideal, but I just can't imagine saying, oh, this is an A, given the asymmetries that are pretty severe. I don't know how to fix them, but I don't.
I just like to echo what Bill said also, which is that, so this is obvious to you, but just so everyone knows. So if you're doing tax reform and you want to move towards full expensing, there's enormous sensibility in limiting interest deductions at the same time. They naturally go together lest you end up with negative tax rates on investment, which I think is the problem that you were hinting at, is that there's a portion of the code today where it's not entrepreneurs per se, but small businesses, or it's really actually firms that have a small amount of investment can expense if they fund it with debt, they can have the advantage of that, and they might end up with very low or negative tax rates. And that's a current preference towards them that it's not entirely obvious what the justification for that is. And so kind of separate from the entrepreneurial discussion, just as we have this great debate in America now between income and consumption taxes, just for those who aren't familiar with this, just keep in mind that if the idea is to move towards something that looks like a consumption tax, moving to expensing and pairing it with rolling back interest deductibility is a logical, coherent thing to do.
Maybe I might make one more comment in response to that, okay, which is that I do think my hobby horse this afternoon has been this issue of loss offsets, and I just want to observe that we have a tool that allows startups to effectively offset losses. It's called the LLC. The passive activity loss rules do limit that, but they permit the taking of losses when the investor disposes of the interest. People can do that math, so I kind of would do nothing. I think I kind of would sort of basically wait for startups and their advisors to figure out that they can use the LLC and it's just not that hard. And I do think, even though we don't see it in the data yet, that's beginning to happen.
We have an email from an actual small business owner, which might be a good way to end. His name is Mike. That's all he says. As a small business, he says, I don't think that the loss issue is as big as being expressed. All startups will have a lot of losses in the beginning. The losses actually force a business discipline on the entrepreneur. Having a good idea in business is never sufficient to be successful. It's necessary but not sufficient. Having, in addition, discipline to manage losses will be more important for the survival of the business. The big problem for entrepreneurs is the cost of startup capital and access to capital. Businesses have plenty of tax benefits that employees don't, that allow for a great deal of tax planning out of the gate. Timing of receipts and payment of business expenses can have a substantial impact on tax liability in any given year. Entrepreneurs get stronger pre-tax benefits through profit-sharing plans than employees get. Tax planning really comes into play once a business is going to survive. Then effort can be devoted to managing liability. There was no question, but it was good to hear from a small business owner. Do you want to comment on that, or?
One way to think about it is that the government becomes the provider of capital in a loss offset regime, or that it makes it more attractive for people to invest if they can eventually take the losses themselves, for example, in an LLC setup. But I readily admit that that is not the kind of direct, here is the capital answer that most entrepreneurs would be looking for.
Did you want to?
I'm not sure I'm as worried about loss treatment as others on the panel are, but I think that's just from anecdotal contact with entrepreneurs who never think they're going to fail.
Mm-hmm. Yep.
And so whether that has any empirical validity or not, I don't know. But that's a very important research
I agree
question,
with that.
I think.
Optimism bias.
Any other questions? Steve Rosenthal.
Yeah, it strikes me that you're defining entrepreneurs sort of by age. Young enterprises are potentially entrepreneur. And I guess the question I have is, why would we start distinguishing business enterprises based on their age? We don't distinguish individuals and charge infants a different rate than, say, an elderly person with income. And then more generally, if like loss asymmetry is a problem, or even the riskiness of early ventures is a problem, why don't we just find more innovation in larger mature firms that can take their losses? Apple continues to innovate even after, Bill Gates finished as his entrepreneurial stage by your definition.
Steve Jobs.
I would never say that there's not a lot of innovation going on in large businesses, and it's fine. I'm just not sure that it's quite fair to say, oh, gee, if you're not going to have the small business do it, the big businesses will just naturally step in and fill the void. It's not clear to me that that's, if we didn't have a tax system, what would you observe in the economy? That's usually kind of what the economist benchmark would be. And I think you would see some people wanting to have small firms and young firms. You're right, entrepreneurs can be in long-standing, modest-sized firms. That's okay. I think the age thing really comes back about that as you'll grow out of this and you'll grow bigger and you'll diversify what your projects are doing. So that's why a lot of this gets caught up in age. But I'm not sure I would just want to say, let's just leave the innovation in the world to the older firms. Seems like a non-neutrality I wouldn't want to have.
Yeah, I guess I would just add, so the young versus small thing, I think first is important to understand about how our dynamic system works. That you often hear these claims that small businesses create a disproportionate share of new jobs in the economy. And it turns out actually what's going on is that it's the young ones that really systematically do that, because a certain fraction of the young ones turn out to be fast growing and create a lot of change. Then just as sort of a matter of logistics, young firms are the most likely to create this loss asymmetry thing because they have no past that they might be able to use some of their losses against. And so they kind of are automatically candidates for that to be a problem for them.
Yep.
Any final comments? No? I want to thank Tax Policy Center for holding the panel and thank everybody on the stage for raising an enormous number of good issues.